So hello everyone and welcome to today's program by Exponent Philanthropy. Exponent Philanthropy is the country's largest association of funders and the only one dedicated to serving foundations with few or no staff, philanthropic families, and individual donors. Our vibrant network has in common lean operations and a style of philanthropy motivated by personal passion, community needs, and a strong desire for better outcomes. We provide high quality and cost-effective programs, resources, and connections that maximize our members' dollars and time for the benefit of diverse communities and causes. Today, you're joining Module 1 of a 3-part Legal Essentials virtual seminar. By the end of this 90-minute session, you should know the legal basics of what you have to do to run your foundation. The next 2 sessions will take deep dives into grant making and self-dealing and conflicts of interests. All of these sessions will be recorded and available to you until August 31st, 2019. I also will send out a copy of the slides, and if you want to have the slides now, you actually have already been sent a link to those slides. It's in the same email that you clicked to join this webinar. At the very bottom, there's a link where you can download the PDF of the slides. I'm Althea Georgantis. I'm a program manager at Exponent Philanthropy. I'm here in our DC office with my colleague Madeline, who will be helping out with your questions today. I just want to give a quick overview of how we're going to be using Zoom today. So depending on the version of Zoom you have, your controls will either be here on the top left of your window or down in the lower middle. And first, I just want to highlight that audio settings button. That's where you can adjust your listening options at any time. And that's also where you can opt to call in by phone if your internet connection is making the audio shaky. And then secondly, I want to highlight the chat function, which a few of you have already found. That's how we'll be receiving all participant comments and questions today. So one important thing is if you want everyone to see your chat, make sure to enable all panelists and attendees circled here in red. Otherwise, it'll just come to us as the panelists. We will be pausing periodically throughout the presentation to take questions. So enter in your question as it comes up throughout the presentation, and we'll do our best to get to it. I actually want to take a moment right now to make sure everyone knows how to use the chat and also get an idea of who's participating. So I just want to request everyone chat your organization and location. And again, make sure to use that option to send to panelists and attendees so everyone can see. Great. And as those come in, I see a lot of you are joining. We have over 100 people on the call. And again, so don't use the raise hand function, it's the chat function. That's how we'll be taking questions today. And while those keep coming in, I'll introduce our speaker, who is Darren Moore. Darren's practice focuses on the representation of nonprofit organizations and social enterprises. He advises clients on a wide range of tax and legal compliance issues, including organization of various types of nonprofit and social enterprise entities, obtaining and maintaining tax-exempt status, risk management, employment issues, governance, and other business issues, as well as handling IRS audits, attorney general investigations, and litigation matters on behalf of his exempt organization clients. And with that, I will pass it over to Darren. Darren, welcome.
Thank you, Althea. Welcome, everyone, to, I suppose, my office here in Fort Worth, Texas. I'm thrilled to be with you. We're going to start by, as Althea said, this is really an overview and is going to set the stage for the next couple of modules. So I want to start by giving you an agenda of what I'm going to be covering today. And this slide shows that agenda. We're going to walk through each of these issues. And as Althea mentioned, if you have questions, please type them into the chat box and we will work to get to those. We want to make sure that you understand the rules here are not necessarily best practices. These are rules that you need to follow to avoid penalties, to stay in compliance with the IRS, to stay out of the newspaper unless you want to be in the newspaper. So hopefully by the end of this hour and a half of time that we have here together, you will be comfortable with the 8 items listed on this screen. So let's jump into the first item, which is follow public disclosure laws. There we go. So there are certain documents that for a private foundation are required to be made available to the general public. Perhaps the most important of these documents is your Form 990-PF. Your Form 990-PF is a document that I'm going to talk about in just a moment in a little bit more detail, but it is your information return, effectively your tax return if you are a taxpayer. Your Form 1023 also has to be held open to the general public. Many organizations don't realize this. This is the document that was filed when you received a letter from the IRS that says, we determine you are exempt under Section 501c3 and you're classified as a private foundation. When you received that letter, it was because you or someone on behalf of your organization filed Form 1023, which is an application for recognition of exemption under Section 501c3. In my practice, I find that many clients that already exist come to me and I say, may I see your Form 1023? And they are not able to put their hands on it. They don't know who filed it. Maybe it was filed a generation ago. They don't know if it was maintained by the CPA who filed it, by the attorney who filed it, but you do need to have that documentation. And then the third document that has to be held open for public consumption is your Form 990-T. Some of you may not be as familiar with this document. This is the tax return where you report on your unrelated business taxable income. So for example, if you engaged in some revenue producing activity and generated income and it wasn't related to your exempt purpose, that's unrelated business taxable income on which you pay the unrelated business income tax, often referred to as UBIT. For private foundations, this typically will come up with investments because a component of UBIT is related to debt financed income. If you borrow money to make money, that's called debt financed income, and you pay tax on that at the highest corporate tax rates, or if you're a trust, at the trust tax rates. And so if you're engaging in certain types of investments where there's an arbitrage feature, you may be generating some taxable income. So that's something that you'll want to visit with your accountant about. Now, most organizations are going to make their 990-PF available on a website as opposed to simply saying, send us a letter and we'll give it to you. Many organizations don't post it on their website, but most of my clients now will either post it on their website or ensure that it is posted on guidestar.org, which collects all the Form 990-PFs. It's usually about a year old, so sometimes you will actually get requests from individuals that say, we want your most recent 990-PF because the one on GuideStar is old. And you actually do have to answer those requests. You have to copy it and send it to them. It doesn't matter. They don't have to have a proper purpose like they might have to under state law. They simply have a right to these three types of documents. You charge $1 for the first page and 15 cents for each page thereafter if you were charging the person. But you do have to make them open for public inspection. And because they're going to be open to public inspection and for public consumption, you want to think about who is it that's going to be reading these documents. Again, particularly the 990-PF, because at this point your 1023s are filed. You don't have an opportunity to change that. It's a historic document of what you believed you were going to be doing when you started your organization. But with respect to your 990-PF, what you're going to be filing every year, think about who's going to be reading this. Number one, it's going to be read by many grantees. They want to know, what type of grants have you been making? What size of grants have you been making? To whom have you been making grants? And for what purposes have you been making grants? So to the extent you're trying to limit your grant making in one area, if you show on your 990-PF that you're willing to make grants in other areas, you're going to get additional requests. Reporters often look at your 990-PF. I get calls from reporters every once in a while asking me to help them understand something that has been disclosed on the Form 990-PF. Perhaps you've disclosed that there was an incident of self-dealing, which we'll talk about in just a little bit. It'll be shown on your 990-PF, and reporters may grab that. The IRS uses a 990-PF oftentimes to determine who they're going to audit. If you disclose that you engaged in a prohibited transaction, the IRS is often going to focus on that and audit that issue on your 990-PF. And then in most states, it is the Attorney General who is the state official responsible for oversight of charitable organizations. In some states, it's in a different state official, but for most states, it's the Attorney General. And the AG is also very interested in the data that goes in your 990-PF because, again, it's freely available information about what you're doing. So here is the cover page of a Form 990-PF. This is something that gets filed every year. And as the second bullet point says, it's due on the 15th day of the 5th month following your tax year. And so if your tax year is January 1 to December 31, it's going to be due on May 15th. If your tax year is something else, then you just look out to what's the 15th day of the 5th month following the close of our tax year. That's when it's due. You can get a free 6-month extension. You have to actually request it. So if you request the extension, it's automatically granted. You request it by filing Form 8868, not that you necessarily need to know that. If you owe tax in relation to your 990-PF, and you almost always will, and I'll explain that when we come to the tax on net investment income, you have to pay that tax when the form is due. So for example, May 15, but you can then get an extension to when you actually have to file your full Form 990-PF. And the 990-T is due at the same time. And in fact, if you've engaged in a prohibited transaction, which are things such as self-dealing, the other things we're going to talk about in this seminar today, if you engage in those types of prohibited transactions, there's also a requirement that you file something called Form 4720, which is where you give more information about the prohibited transaction. That's also due on the same date as your Form 990-PF. As a side note, Form 4720 is not a publicly available document, so you don't have to make that publicly available. There is a penalty for failure to file. There's a daily penalty up to a maximum. And if you don't file for 3 consecutive years, you will automatically lose your tax-exempt status. This is a new law that Congress put into effect several years ago. It caused the loss of exemption for many, many, many charities, primarily smaller charities and not private foundations. But the same rule applies to private foundations. If you fail to file for 3 consecutive years, you automatically lose your tax-exempt status. And to get your tax-exempt status back, you have to file a new Form 1023. So we're done on the 990-PF. Let me look over and see if I have some questions here. I know one of the questions that I saw, how do you get the Form 1023 if you don't have it? There is, and I don't know the form number off the top of my head, but there is a form that you can send to the IRS where you request a copy of your Form 1023. It takes them a little time to process it, but the IRS should have a copy, right? We send it to the IRS, and there is a form you can send in to request that copy. I thought GuideStar didn't count as public disclosure. It does count as public disclosure. And do you have to provide the entire 990-PF, or can certain pages be excluded? To the extent you have donors, you could exclude that. Typically, that arises more for public charities who are not required to make public Schedule B, which is their donors, although some states are now looking at whether to require that. But generally, the entire thing has to be filed and has to be open for the public. Okay, I think I've answered the questions I've had so far. So let's go to topic number 2 on our checklist, update governing documents. And really update your key documents, not just your governing documents. So what are governing documents? Number one, if you're a nonprofit corporation, governing documents are going to be the document you filed with your state to create the organization. In Texas, we call that a certificate of formation. Used to be called articles of incorporation. Many states call it articles of incorporation, articles of organization, something along those lines. That's your governing documents. Your second governing document is your bylaws. And so your certificate of formation or articles of incorporation are superior, if you think of it in a hierarchical sense, to your bylaws. If there's a conflict, the articles of incorporation control over the bylaws. Typically, you're not going to have a conflict because you're not addressing the same issues in the two documents. But where I sometimes will see a conflict come up is your bylaws control kind of what you do every day. How do you call a meeting? How many directors do you have? Who are your, how many officers do you have and what positions are they in? What counts as a quorum? All of those types of questions are in your bylaws. And your articles typically are things like, here's our principal office, here's our registered agent, here's our purpose, here's our dissolution clause. But sometimes you can get the same information that may be in both documents. I'll see organizations that have a dissolution clause in both documents. You're only required to have it in one, but you may see it in both documents. Well, if your articles of incorporation say on dissolution, all of our assets are going to go to such and such community foundation, but at some point you've decided we don't really want to do that. And in your bylaws, you say all of our assets are going to go wherever the board of directors decides on dissolution. You've got a conflict. And the articles, sending it to that community foundation in my example, control over the bylaws. And what I typically see is organizations will amend their bylaws because that's the document they're working with, and they'll fail to go back and look to see if they need to amend their articles of incorporation. So make sure those things line up. Number two, or I guess a third governing document, just to put this aside, is things such as resolutions. Resolutions are third in line behind articles of incorporation, bylaws, and then resolutions. And so resolutions are typically going to be found in your minutes, so you want to make sure that you keep copies of your minutes. I've said all this in the context of a nonprofit corporation. For those of you on the phone that may be working with a private foundation that's organized as a charitable trust, you'll know that there is no articles of incorporation. There is a trust document. Sometimes that trust document is called a declaration of trust. It may be called a trust agreement. And sometimes you'll have a private foundation charitable trust document that actually was embedded within a will of a decedent. It's called a testamentary trust. Wherever that is, that original trust document needs to be maintained. Second, you want to make sure from an IRS compliance standpoint that you're updating your documents. When you update any of these, when you update your articles, when you update your bylaws, when you update your charitable trust, you need to send a copy to the IRS. There's a box on the 990-PF that says, did you update any of these? You check yes, you send them a copy. You also want to make sure if you can, I don't want to say completely change, but substantially change what it is you're doing, you need to update the IRS. Again, there's a box that you check to update the IRS. If you're going to change what your office is or what your name is, all of those things need to be updated with the Internal Revenue Service. And kind of like with Apple, there's an app for that. There's a form for that. There is always going to be a form to update your name or your principal office with the IRS. And then you've got your operational and administrative documents, things like employee records, financial records, bank accounts, stocks, bonds, mutual funds, contracts, leases, any of those types of things. You want to make sure that you have a document retention system in place, knowing how long you need to maintain each of those. And I know Exponent Philanthropy has a number of good sample document retention policies. The Form 990-PF actually says, do you have a document retention policy? and you check yes or no. While it's not mandated by the IRS, I would suggest that you have a document retention policy and that you have the ability to check yes with respect to that document retention policy. Okay, once again, we're done with number 2, so I'm going to glance over and see what questions we have. We had another question about can we post our 990PF on our website, and the answer is yes. You don't have to. It can be on GuideStar, or you can post it nowhere. And there are organizations that if someone wants their 990, they simply say send us a letter or send us an email. There's a place on the 990PF, I want to say it's on the bottom of the first page, that says the books are in the care of, or the 990PF is in the care of, and so people can use that address to request it. So it's not required that you post it. It's required that it be open to the general public. And the easiest way to make it open to the general public is to have it out on the website. If we update our bylaws, do we need to have them reviewed by a lawyer and or filed with the state, or is it enough to have the board pass them in the meeting and note that in our minutes? I'm not going to speak to whether you have to have them filed with the state, because states differ on that. I can tell you in Texas, you do not. But should we have them reviewed by a lawyer? Well, it really depends. If what you're doing is changing the number of directors from 3 to 7, or changing a vote from majority to supermajority, you probably don't need to have that reviewed. But if you're undertaking substantial changes and your board doesn't have legal expertise on it, I would suggest you have those reviewed by someone with legal expertise. But it's certainly not mandated. Do I suggest bylaws include specific details of who will replace board members if a succession event occurs? Typically, you're not going to have something that says who replaces specific board members. In many states, Texas is one of these states, we can distinguish between members. It's kind of like a shareholder, except you don't own anything. It's more of a right of control, and directors. Oftentimes, we will have succession planning for members, but not for directors unless they hold a specific position. If we have classes of directors, and this individual asked about founding directors, sometimes we will have provisions related to that. But I don't typically suggest you're going to have specific details of the specific individuals who would replace directors in the event of a succession event. I also wouldn't put that in a separate governing document. I think you want to have qualifications for directors, and then the board is going to vote on, or the membership, if there are members, is going to vote on who replaces those directors. Do you update IRS with filing of 990PF or at the time the change occurs? It's easiest just to do it with your 990PF. It says, did you make a change within the previous year? And you check yes, and that's what you do. To whom do we send our bylaws, and should these be attached to the 990PF? And should it happen with every update to the bylaws? You should send them to the IRS. They should be attached to the 990PF, and it should be with respect to every update. It's just a matter of checking the box and saying, here it is. Are records stored digitally acceptable for document retention purposes? It's going to depend on what your policy says. Typically, yes. But for example, if you're talking about your original trust document, then you're going to want to have the original if at all possible. How long do you have to retain documents? That's going to be in your document retention policy. And I see that Lauren has given you a couple of links there. And will we get transcripts of the chat? And I will leave that to Lauren. So we've done number 1 and number 2. Let's move on to number 3. We're now moving into what I call prohibited transactions. There's a series of transactions or events that are outlined in the Internal Revenue Code, sections 4941 through 4945, that are effectively thou shalt nots. Here's something that you can't that you can't do. It's a little bit awkward to say that related to the 5% obligation, because of the way the code says it is. You can't not give away 5%. So they kind of forced it in there. But the rule is this: you've got to give away every year roughly 5% of the fair market value of your assets. And that's your minimum distribution requirement. Let me say one thing here. I'm not talking about private operating foundations. Most of what I'm saying here in this webinar is going to apply to private operating foundations. This rule does not apply in the same way to private operating foundations. If you're not sure if you're a private non-operating foundation or a private operating foundation, I'm happy to help you offline with that. You're probably a non-operating foundation. Private operating foundations typically are not giving away money. They're using their money directly for charitable purposes. They operate much more like a public charity. So you've got to give away 5% of your assets. That's your minimum distribution requirement. It's not required in year one. It's got to be to accomplish your charitable purposes. They're called qualified distributions. I'm going to talk a little bit more in detail about that momentarily. How do you make the calculation of what the 5% is? It's your non-charitable use assets. Basically, that's typically your investment assets, but it's any asset you own that's not owned for charitable use. Now, if you own a building and the building is where you conduct your charitable operations, then that's a charitable use asset. But your non-charitable use asset, typically your investments, you're going to value those to give away your 5%. Now, keep in mind that you're not always just going to own cash or stocks and bonds. You're going to own real estate. You may own art. There may be any number of things that you own. And the Treasury regulations are very specific in the rules for valuing these various things. How you value them is different. How often you have to revalue is different. For example, with respect to stocks and bonds, you're going to value every year. You'll get an updated value of your portfolio. With respect to real estate, you only have to do it once every 5 years. Same for oil and gas minerals, for example. And you have to distribute by the end of the following year. So we look at your 2019 assets. Do we know what the value of your 2019 assets is right now? No, because we're not to the end of the year of 2019. But once we're at the end of the year, we can look back at what your assets were, the average fair market value of your assets for 2019. And by the end of 2020, you'll have been required to distribute 5% of that amount. So how do you calculate what you have to distribute? And this is a little bit, there's a lot on this screen. It's a little bit smaller than what we've seen, but there's a lot on the screen. But this is a page taken out of the 990PF, and it tells us how to calculate our minimum investment return, and that is what the 5% is. But there's all sorts of little modifications to it. So let's kind of walk down this. Fair market value of your assets is going to be comprised of the average monthly fair market value of your securities. There's rules as to how to get the monthly fair market value of securities. The average of your monthly cash balances, the average of all your other assets, you total those up. There are then some reductions that you can see there. You get down to line 4. Line 4 is helpful because it says that 1.5% of the average fair market value of your assets is deemed cash held for charitable activities. So you're actually kind of get to take that and set it aside, and that's something that you don't have to distribute the 5% on. That gives you the net value of your non-charitable use assets, and then 5% of that is your minimum investment return. You don't distribute your minimum investment return, and I know some of you, your eyes are glazing over, and that's fine. There are plenty of accountants out there that I'm sure are more than happy to help you figure this out. But you get to minimum investment return, and then you pull that down to part 11 for your distributable amount. Because there's going to be some tax that you've paid, again, net investment income tax, which I'll come to. There may be some unrelated business income tax that you paid. You don't have to pay out 5% on those amounts. There may be some things that you paid in previous years that you had to recover for some reason. You made a grant, the purpose fell through, the organization gave it back to you. You have to pull that back into the 5%. But you do these various machinations to your minimum investment return, and that comes down to your distributable amount. And again, that has to be distributed by the end of the subsequent year, and it has to be distributed in something called qualified distributions. Qualified distributions is much broader, I think, than most private foundations believe it to be. Many private foundations will simply make grants to charitable organizations. They'll make grants to universities or to hospitals or to schools or to the opera or the ballet or the zoo or whatever, these large charitable organizations, and that's fine. Those are the easy grants. Those organizations are referred to by designation in the Internal Revenue Code as 509A1 and 509A2 public charities. And you can always make grants to those types of charities. There are some specific rules that sometimes apply, even with those easy grants. If the private foundation or its disqualified persons control the public charity, then there are some special rules that apply if you want it to be a qualified distribution. You also get to include grants that may be more difficult that we're going to talk about in a little bit, but grants to international organizations, grants even to for-profit organizations if it's for a charitable purpose. Now, there are rules that you have to follow, but you could make those grants. We'll come to that. Grants to individuals for charitable purposes. Again, there are rules you have to follow. Really, the only thing that's not going to count is a grant to what's called a supporting organization, a 509A3. And if it's non-functionally integrated, which is a little bit more detailed than we need to get into today, those types of grants don't count as qualified distributions ever. So if you're doing something other than what I'll call the plain vanilla grant to charitable organizations, make sure you've got someone on your board who has some expertise in that, or reach out to a professional for assistance. You also get to count as a qualified distribution reasonable and necessary administrative expenses, but only the administrative expenses related to the foundation engaging in its charitable purpose. So, for example, grant making. If you have administrative expenses related to investments, like investment fees or oversight of investments, that is not a qualified distribution. But if you pay a program officer $100,000 a year, that $100,000 counts as part of your 5% distribution. Direct charitable expenses count as part of your 5%. For example, if you went out and after a storm bought a bunch of blankets and went down to the coast and handed out blankets to hurricane survivors, that'd be a direct charitable expense. You could count the cost of those blankets as part of your 5%. If you convened a seminar on a topic that related to your charitable purpose, that counts as part of your 5%. There's something in the regulations called a charitable set-aside that counts as part of your 5%. It basically means we're going to have some large project. We need to gather money up over several years and pay it out in a specific year because we don't want to pay it too early. We want to wait until the project's done or whatever the case may be. You can ask the IRS to give you a charitable set-aside letter, and they'll say, okay, we recognize that you are going to take this year's qualified distributions and move them to next year or the following year. But you do have to get specific permission from the IRS related to that. And then there's something called a program-related investment. And a program-related investment merely means that instead of making a grant to a charity, for instance, you're making an investment. So the primary purpose has to be charitable. No substantial purpose is generating income or appreciation of property for the foundation. And no purpose is lobbying, campaign intervention. If you fit within that rubric, which usually you'll get a legal opinion to determine whether you do or don't, then that's considered a program-related investment. So for example, let's say you made a low-interest loan to a charitable organization because they needed money, they wanted to set up a soup kitchen, and you made a 1% loan. Well, clearly you're giving it to them for the primary purpose of a charitable purpose, setting up a soup kitchen. It's not, no substantial purpose of that is generating income because you're giving it to them at 1%, and there's nothing in it related to lobbying or campaign intervention. So when you make that loan, it's not a grant, it's a loan. When you make that loan to that charity, that counts as part of your 5%. And while the loan is outstanding, even though it's an investment, it's not part of your, quote, investments on which you calculate the 5%. When the loan is repaid, it increases your 5% in that part 11 that I showed you on the prior slide. So what happens if you don't satisfy the 5% requirement? There's a penalty for distributing too little. It's 30% of the shortfall. The foundation has to pay that. You got to make it up. You've got to actually go distribute the amount, but then you have to pay 30% of the shortfall directly to the IRS. And if you fail to do so timely, then there's a 100% of the shortfall penalty. So it can get steep. That also shows you what in general is how all these penalties work. They're tiered. Here's the penalty if you don't fix it. Here's a more significant penalty. There's also penalties for the wrong type of expenditure. Those are called taxable expenditures, where you're making grants for non-charitable purposes. We'll come to those in just a bit. Okay, I know that there have been a number of questions while I've been talking through this, so let me look and see if I can answer any of those. Is the 5% giveaway requirement waived in year 2 or year 3, or strictly only waived in year 1? Well, so the reason it's waived in year 1 is because you don't actually have to distribute until the year following. So it's typically not waived in year 2 and year 3. However, there's a really kind of funky rule that allows you to make some distributions over time to build up, and it's complicated, and I don't really want to get into it today, but generally speaking, you need to make the payout in year 2 and year 3, etc. How is fair value of an investment measured? I'm going to leave that for others. Happy to discuss it offline as well, but suffice to say, you're looking at the highs and lows, and there's a way that you average that out. You have 12 months from the end of the year to give away the 5%. You have 12 months from the end of your tax year. So if you're a calendar year taxpayer, then you have till December 31 of the next year to give away your 5%. I'll let the exponent folks answer whether they have the written document outlining which organizations can receive the minimum distribution. What travel and hotel expenses are reasonable? That's really a question that's probably a little bit more specific than we should handle right now, but if we have time at the end of the seminar, please ask me again. What are restrictions to give to overseas entities, such as a school for scholarships? Bookmark that question. I'm going to talk about it in just a minute when I talk about taxable expenditures. It's also going to be a part of a future module on how to conduct expenditure responsibility. So with that, let's move to step or checklist number 4, avoiding self-dealing. Self-dealing gets a lot of attention by private foundations, and rightly so, because it's one of the easiest prohibited transactions to trip over. And it's also easy to avoid. So to avoid it, you simply need to understand some definitions. The definition of self-dealing is a direct or indirect transaction, typically financial transactions, but it doesn't have to be financial transactions, between a foundation and what the Internal Revenue Code calls a disqualified person. So here's some definitions that we need to understand. What is a disqualified person? We know what the foundation is. So if it's got to involve a disqualified person, who is a disqualified person? Officers, directors, and trustees, and individuals who exercise the rights of officers, directors, or trustees, if they're called something else, are always going to be disqualified persons. I call those foundation managers. Second type of disqualified person is someone who's referred to as a substantial contributor. It's what you think of when you think of substantial contributor. Where did all the money come from for the private foundation? But the specific definition is a person who's given more than 2% of all of the assets of the foundation since its creation, provided that 2% is over $5,000, which it almost always is. Number 3 is family members of foundation managers and substantial contributors. And by family members, it's kind of a weird rule. We include, excuse me, parents, grandparents, children, grandchildren, spouses, but we don't include brothers and sisters. So siblings are not family members for purposes of the self-dealing rules. Not sure why Congress did it that way, but that's the rule. So in addition to foundation managers, substantial contributors, family members, you then have an entity where more than 35% of the entity is controlled by any of the people that I've talked about: foundation managers, substantial contributors, or family members. If any one of those people, or collectively those people, own more than 35% of an entity, then that entity is a disqualified person. In addition, if you are a person who owns more than 20% of an entity that is itself a disqualified person, then you're a disqualified person. The best way to think about this is, suppose that a corporation or a company sets up a company foundation, and the company funds the foundation. So the company is the substantial contributor. Well, then an individual who owns more than 20% of the company is also going to be a disqualified person. And again, it's really critical to understand who we're talking about for disqualified persons. I often tell my private foundation clients, keep a list, because this can change. When your child gets married, now your daughter-in-law or son-in-law becomes a disqualified person, and entities that they own more than 35% of become disqualified persons. Because if you don't have a disqualified person, you're never going to have self-dealing, unless it's indirect self-dealing, but that's simply sticking another organization in between to try to get away with what you know you can't get away with directly. So you need to have a DP for it to be self-dealing. Always look, do we have a DP? If you know we do have a disqualified person, then you're going to say, is it a transaction that is self-dealing? And there's going to be much more detail in a subsequent module about this. So I don't want to get into all of the transactions that are self-dealing, but again, typically is an exchange of some sort of value between disqualified person and the private foundation. Rule of thumb, if it's free to the private foundation, it's almost always going to be okay. And then third, does an exception apply? And again, you'll get this in a subsequent module, but the most popular exception to apply is compensation for personal services. So don't fear that all transactions between disqualified persons and the foundation are going to be self-dealing, but be cautious of all transactions between disqualified persons and the foundation, and ensure that if it's a listed transaction, which we'll talk about in the next module, that there is an exception. Again, the exceptions will be discussed. And the reason I'm kind of skipping over this is there's a number of listed transactions and there are many, many exceptions. And so that really can take an hour all by itself. Make sure you distinguish between self-dealing and conflicts of interest. The easiest way to distinguish between these two is self-dealing involves a disqualified person and a conflict of interest does not. So a conflict of interest is any situation where the board or staff or interested party, I would even exclude board here. I would say staff or interested party, people who aren't self-dealing are benefiting from work with the foundation. Sometimes it can be the board if it's not a listed transaction, but typically this is going to apply to non-disqualified persons, and there's no fines related to this. There's no IRS obligation to put anything on your 990 PF. Instead, it can get you bad press, and it can cause the AG to investigate, and it could cause the IRS to investigate. If it were something egregious and the IRS discovered it, they may decide, gosh, if they're willing to do this, we better go dig around and see what else may be there. So you want to make sure that you appropriately manage your conflicts of interest. And the best way to do that is to have a conflict of interest policy. Again, you can find samples from Exponent Philanthropy. And you have a policy, it's going to say individual who is conflicted because of, they have a financial interest, or their child is on the board of the grantee, or whatever the case may be, that individual recuses himself or herself from the decision and lets the disinterested directors decide. That's typically the way you're going to manage the conflict of interest, though not always. So just be aware that there's a difference between self-dealing and conflict of interest. Okay, I'm going to stop and look over at my questions. Could serving on the board of a grantee create self-dealing or a conflict of interest? It's typically not going to create self-dealing. I could come up with a hypothetical where it could. If you serve on the board of the grantee, and because you're serving on the board of the grantee, let's say the grantee pays its board members compensation, that could create a situation where you want to see if they're self-dealing and whether an exception applies. Oftentimes, that'll be viewed as a conflict of interest. Nevertheless, I have many, many clients who like to have their board members or their executive director serve on the board of the grantee so that they can speak into what that grantee is doing, and so that they can have some visibility into what the grantee is doing. So it may be a conflict of interest. I tend to call those dualities of interest, where you owe dual interest. But again, that's a situation not necessarily to be prohibited, but to be aware of and managed. I skipped a question. Disqualified person, the person who gives more than X% of X. A substantial contributor is a person who gives more than 2%, 2% of all of the assets of the foundation since its inception. So you look back and you say, okay, how much has been given to the foundation? Has this person given more than 2% of that? And it's got to be more than $5,000. So for example, if someone paid to have it set up and they gave $3,000 to an accountant to set it up, that's not going to make that person a disqualified person. Let's see, can you give a few nuanced examples of self-dealing that might not be thought to be self-dealing at first? I'll give you one example, and then I'll leave the rest to your next module. Let's say that you have a landscaping company, and you paid the landscaping company to do landscaping around the building of the private foundation. Clearly, that's fine. It's not self-dealing. But unbeknownst to you, the daughter of one of the board members marries a passive investor who happens to own more than 35% of the landscaping company. Well, now the son-in-law of a board member, meaning a family member of a foundation manager, owns more than 35% of an entity that's receiving compensation from the private foundation. And I will tell you, as a preview, there's no exception when the compensation is being paid for something like landscaping. That's an exception of where you get tripped up. And that's why I say you want to make sure you know who your disqualified persons are, and that you look through, is there a disqualified person? Is it a listed transaction? Is there an exception? Is a conflict of interest for an employee to attend a grantee's gala? Typically, that is not going to be a conflict of interest, particularly if it is an employee and not a foundation member. It could be self-dealing if it were a foundation member, potentially. Typically, there's a way around that, but I'll leave that for the self-dealing module. How can a foundation pay a family member as a contracted consultant for their work? These questions are all getting into specific self-dealing situations, and I promise you're going to have a great seminar on that. So I am going to move on for sake of time and talk about, and if we have time at the end, I can answer a question or two into that, but you're going to get some great answers on those. Those are all very, very good questions that come up in the context of self-dealing. Avoiding taxable expenditures. Earlier, I said that one of the ways you can get in trouble is either not making enough distributions or making the wrong kinds of distributions. And the wrong kinds of distributions, the Internal Revenue Code calls taxable expenditures. It's an expenditure not allowed by the IRS, effectively not allowed by the Internal Revenue Code, either because the code says thou shalt not make this type of expenditure, or because you did it without following the necessary rules. Let me give you an example of the first. You decide we really want certain individual to become mayor of our city. And so you give $5,000 to that individual's campaign. That is a thou shalt not. There's no extra steps that you need to follow. Just know intervening in political campaigns for or in opposition to a candidate for elective public office is prohibited for private foundations. It's prohibited for public charities in general. And so you can't make that type of distribution. And if you do, it's a taxable expenditure, which means you're going to pay tax on it. You also have to get it back, or at least exert reasonable efforts to correct by getting it back. If your board members want to make that type of distribution, tell them to take out their checkbooks. You can do it in your individual capacity, but the foundation cannot do that. And I'll come to lobbying in just a bit. Examples where there are extra steps to follow are scholarships or any grant to individuals for travel, study, or, quote, similar purposes, such as writing a report, something along those lines. What are those extra steps? Well, you have to go to the IRS before you make the grant. Tell the IRS, here's a description of our grant program. Here's how we're going to go about doing it. Here's the composition, how either specifically who's going to be on the committee who decides, it's going to be the board members, or how those individuals are going to be selected. We're going to get educational professionals in our city to give advice and to select the candidates for the scholarships. You've got to get that type of information. How many scholarships you're going to be giving. You can give them a best guess. How much are they going to be? Again, a best guess. Are you going to give it specifically to an individual? Or are you going to pay expenses for that individual? If you're paying college scholarships, are you paying it to the individual? Or are you going to give it to the college and say, use this for the individual? Any of those situations, you've got to go tell those things to the IRS. You use Schedule H, which is on Form 1023. So if you're starting a new foundation, you can tell them up front, we're going to do this and include Schedule H. But if you're going to start doing this and you haven't gotten pre-approval, then you file Schedule H. There's an interesting rule that says 45 days after you filed, if you haven't received word back from the IRS, and let me promise you, you will not within 45 days, you can go ahead and make the expenditures and they will be qualified distributions and not taxable expenditures, provided you do so in accordance with what you told the IRS until the time that the IRS ultimately rules. Now, if the IRS ultimately says, no, you're doing it wrong, all of those are okay, but you wouldn't be able to continue in the same practice. I also want to distinguish giving money to a university for scholarships versus giving money to a university to provide a scholarship for a student you select. Those are two very different things. If the foundation is selecting the recipient, that requires pre-approval for it to not be a taxable expenditure. If the university is selecting the recipient, so you're giving money to a university and saying, use this for scholarships, not telling them who to select, that does not require pre-approval, because that is a grant to the university, not a grant that is technically to or for the benefit of an individual. Other types of grants to individuals don't require extra steps. So grants to individuals for disaster relief, for instance, do not require pre-approval. Grants to individuals for relief of poverty do not require this pre-approval. In addition, if you're giving money to a non-public charity, remember I said 509A1, A2, and A3s that are other than the odd one that I called non-functionally integrated, more than you need to know right now. But if you're giving money to something that's not a public charity, there's rules you have to follow. Those rules are called expenditure responsibility rules. They'll be covered in great detail in the next module. Very, very succinctly, it means you have to do due diligence into the organization. For example, let's say you're going to give money. I think somebody asked a question, what if we want to give money to an overseas university for scholarships? Well, you'd have to have pre-approval, number one, but let's say it's just to an overseas university, period, or to a university or to a museum in another country or a hospital in another country. To do that, because they're not a public charity, they weren't organized in the United States, and they may go in, an international organization can always go and get a 501c3 public charity letter by using a 1023, but it very rarely happens. So let's say they don't have a determination letter. They're truly just an international organization. You need to do due diligence to make sure that you can accomplish what you want to accomplish. You need to enter into a grant agreement with them. It needs to have all sorts of little bells and whistles about what happens if they don't accomplish it and how they have to get the money back. They have to report to you on how they're using the money, and you have to report to the IRS. Again, you're going to get quite a bit more detail in the next module, but that is expenditure responsibility. And expenditure responsibility applies anytime you're giving money to an organization that is not a public charity, that does not have that determination letter that says you are a public charity, then you're going to have to follow expenditure responsibility. So therefore, it applies if you're giving to an international organization. It applies if you're giving to a for-profit organization. It applies if you're giving to an organization such as a chamber of commerce that's exempt under a different subsection of 501c, like 501c6. It applies if you're giving money to another private foundation. If it's not a public charity, you're going to have to exercise expenditure responsibility, or you're going to be hit with an excise tax for a taxable expenditure. Okay, I'm going to look over at my questions again. If we give a grant to another organization to fund scholarships, is that possible an extra step situation? It depends on if the second organization is a public charity. If the second organization is a public charity and you're not picking the recipients, all you have to do is give the money to them. You do not have to follow expenditure responsibility. Foundation funds a grant to a university based on a contest, allocated 50% to institution and 50% to a student as a scholarship. Provided the foundation did not select the student, then that's not going to require pre-approval. Did I say that giving to an individual for disaster relief or poverty doesn't require IRS pre-approval? That is correct. That does not require IRS pre-approval. That's not to say that you don't need to have documentation of how you selected the person to make sure that they are an appropriate recipient of your charitable dollars, that they really are impoverished, for example. You will need to have documentation to reflect that, but it doesn't require pre-approval from the IRS. That's the same as the next question. Does it apply if you're giving to an operating foundation? Yes, you still have to use expenditure responsibility if you're giving to an operating foundation, although I said that very confidently. I'm going to pull out my cheat sheet here that I use. Oh, that's just for qualifying distributions. I'm going to stick with the answer, yes. Final answer. Lock it in. Member school band is winner of an essay contest. Person was selected by a third party. grants awarded to the educational institution, which gives a portion to the student that does not require IRS pre-approval because the foundation did not select the individual. Can you avoid expenditure responsibility requirements if you give to an American Friends of organization that itself is in the U.S., provided that Friends of organization, such as Friends of the Louvre, is a U.S. organization and is a public charity? You can give to them without expenditure responsibility. What about giving to C4s? A C4 is a non-public charity. You have to comply with expenditure responsibility. Does it differ if it's an international disaster? Do you need pre-approval for that? Again, the answer is no. The real key here is making sure that you are not engaging in private benefit by giving charitable dollars to individuals that do not fit within a charitable class. That's what you're trying to avoid. Okay, moving on to number 6, pay excise tax. This one is a little bit funny because it's not actually a prohibited transaction. This is not something that you've done something wrong and now you have to pay an excise tax, like you've engaged in self-dealing, you have to pay an excise tax, or you didn't pay out 5%, you have to pay an excise tax. This is just a tax. In fact, private foundations really are not tax exempt. We call them tax exempt, but they actually all pay a very, very small, well, sometimes big, tax, but small in percentage. It was put in place in 1969, and they called it an audit tax because the theory behind it was when they created the concept of the private foundation, which did not exist pre-1969, they said, how are we going to audit all these organizations to make sure they're not engaging in self-dealing, et cetera, et cetera? And they said, well, let's charge them all a small tax so that we have money to audit them. It's not really used for that anymore, but they still charge us the tax. So the tax is the tax on net investment income. And it's a tax on your gross investment income, unless that gross investment income constitutes unrelated business taxable income. You pull that out. But your gross investment income plus your capital gains minus your ordinary income minus your necessary expenses. It's your net investment income. When you come up with that number of your net investment income, you pay 2% of that amount in tax on your 990 PF to the IRS. Every year, you have to pay a tax on your net investment income. I think it's really critical to understand the 5% that we talked about before is 5% of the average value of your fair market assets. So that's 5% of the big bucket of all your money. This 2% is 2% of your investment income, your net investment income. So 2% of what you made in the previous year off of your investments. You can reduce it down to 1% if your qualifying distributions for the year equals or exceeds your normal 5% amount on your big bucket plus 1% of your net investment income. So basically, and there are some mathematical issues that come into play here because of the way you look back over a period of time to reduce it down. But basically, if you can shift 1% of your net investment income away from the IRS to your grantees. So you want to make sure you pay that every year, and you can't reduce it if in any of the previous 4 years you've been found to have not given a sufficient amount to meet your 5%. So 2% of your net investment income. I'm going to come back over to my questions. I think I just answered the reduction to 1%. Are the necessary expenses mentioned here investment expenses? Investment expenses is what I'm talking about here is your necessary expenses. The expenses that you incurred in order to achieve that net investment income. And I see that Lauren is put up a resource for more detailed information on the excise tax and it is a rolling 5-year average, and that's the reason that I said there's some math issues that come into play in reducing the 1%. Okay, investments, number 7 on our list. We're back to some actual prohibited transactions. You're prohibited from having excess business holdings. An excess business holding is a holding in a trader business. It's got to be an active trader business. If 95% or more is from passive sources, then it's not an excess business holding. And if it's a charitable business, one that you hold purely conducting charitable activities, the business itself is conducting those charitable activities, then it doesn't matter if you hold more than the set amount. That very rarely comes into play. So you can't own more than a limited percentage. What is that percentage? 20% of the voting stock of a corporation, 20% of the profits interest of a partnership, or 20% of the beneficial interest of an organization that's formed as a trust. Again, that's not going to be very often because we're talking about active trader businesses. So if you own 20% of either the voting stock of a corporation or profits interest of a partnership, then that excess, let's say you own 25%, that 5% is called an excess business holding. What makes this a little bit more tricky is we don't just look at the amount that's owned by the foundation. We also look at the amount of that trader business that's owned by disqualified persons. So the foundation owns 15%, but there are 2 board members, and they each own 5%. So a total of 25% is owned between the foundation and its disqualified persons. There's now a 5% excess business holdings. That 20% limitation gets raised to 35% if you can show that control is outside of the private foundations and the disqualified person. So if a third party is in control of the business, and then you can go up to 35%. So you have to reduce it to avoid the tax. Here's what's interesting about the excess business holdings. If you receive it by gift, you get 5 years before it's considered an excess business holding. If you receive it under somebody's will, you get 5 years. In either of those situations, you can request an additional 5 years, though it's not always going to be granted. But you get 5 years to dispose of that excess. But if you went out and bought it because you didn't know your disqualified persons owned it, for instance, it's automatically an excess business holding as of the moment you bought it, and you have to reduce it. So there will be a tax that you pay on it, plus you have to get rid of that excess business holdings. And you can't get rid of it by selling it to a disqualified person, because then you'd be engaging in self-dealing. You can always own a de minimis amount, which is under 2%. You can always own any amount of non-voting stock. So there's some ways to kind of deal with this. This is the rule that came into play earlier, well, I guess last year now, with what's called the Newman's Own exception. And that's a little bit of a complicated exception, but if an individual gifts 100% of a business to a private foundation, and the business is controlled by individuals who are distinct from the people controlling the board, there's some specific rules as to how that all works out, then you can own up to 100%. It's a very, very, very limited exception. I'm happy to talk to anyone that may want more information on that, or you can type in Newman's Own exception to excess business holdings, and you're going to find about 1,000 articles online about that very issue. The other thing you have to watch out for in investments are jeopardizing investments. I'm not nearly as concerned with this. They're called investments that jeopardize the short-term or long-term interests of the foundation. There is no per se jeopardizing investment, but the types of investments that might come into play here, some people will point to hedge funds. I think another good one to point to is a working interest in an oil well, for instance, where there's no cap on the amount that you may be required to pay. So it jeopardizes, can we carry out our exempt purpose? Our exempt purpose is to make grants Are we risking all of our assets? Is this a jeopardizing investment? Typically, this actually is dealt with at the state law level as the question of, is it a prudent investment? And the Attorney General is more concerned here from a fiduciary duty standpoint. But there is this analogous federal rule. It's very, very rare to see any private letter rulings on jeopardizing investments where the service has said, yes, that's a jeopardizing investment. See if I have any new questions. Hedge funds are jeopardizing ? Not necessarily. Again, I don't want to say they are, because there is no per se jeopardizing investment. The code says examples of investments that could be jeopardizing investments, depending on the facts and circumstances, are, and hedge funds is something that is talked about. So it's not always going to be the case, but those are things that you want to get with whoever your professional advisors are and determine, is this a jeopardizing investment? Should we be concerned about it? You know, you may want to do some due diligence as to who is controlling the hedge fund, what risk do we have. But I think it's instructive, frankly. This is purely anecdotal, but many of you will be aware that when the Madoff scandal hit, Bernie Madoff represented and invested on behalf of many, many private foundations. And the IRS, to my knowledge, did not bring a single jeopardizing investment, didn't obligate or say, hey, these are jeopardizing investments. I was going to say an action. It's not exactly what they would do. They would audit and then impose an excise tax. But from all the times I've heard the IRS speak on this, they actually didn't do that. So it's very rare that you're going to have a jeopardizing investment. So what penalties apply? I mentioned this earlier, but again, excise taxes, thou shalt nots. If you do, there are penalties. There's an initial tax. It's going to be on the foundation, unless you're talking about self-dealing. Then it's going to be on the disqualified person. And it can be on the foundation managers. I'm going to come back to how those things work. If you don't correct it within the correction period, which begins to run on the date that you receive a notice of deficiency, so you've got quite a bit of time to correct up until you receive a letter from the IRS that says, hey, you did this terrible thing, or you committed the fault, whether it's not, you've got to correct it. That's when the clock starts running, and it's typically 90 days from that date. And if you continue and say, we absolutely are not going to correct it, and we thumb our noses at you, Mr. Internal Revenue Service, then they can revoke your exemption and terminate your foundation. You would be subject to a termination tax, which is the lesser of all the tax benefits that anyone has ever received by virtue of giving to your foundation, or 100% of your assets. So in other words, they take all your money and game over if you are involuntarily terminated. I am not aware of any private foundation that has ever been involuntarily terminated for failure to correct an excise tax, because it's easy enough to correct. And if you're really concerned about whether there is a correction that's required, then you're typically going to be suing the IRS over that issue and not simply ignoring the IRS. So let's talk about that initial tax. With the exception of self-dealing, you can request abatement of the initial tax, meaning IRS, we know we failed to distribute 5%, but we had good cause for failure to distributing 5% because our CPA told us that we had distributed 5%, and here's their letter to us that says you've met the requirement, and that's why we didn't do it. If you have a reasonable cause, the IRS may, in its discretion, abate that initial tax. It can also abate the additional tax. The only time it can't abate an initial tax is with respect to self-dealing. If you engage in self-dealing, the disqualified person is going to have to pay the initial tax. It's important the disqualified person pays that tax. If the foundation pays the tax on behalf of the disqualified person, that's another act of self-dealing. So the disqualified person has to pay the tax. The foundation can't indemnify the disqualified person for paying that tax. on each of these excise taxes, the IRS is also going to look at, did the individuals in charge of the foundation, its officers, directors, etc., knowingly and willfully enter into this transaction. So you knew this was a taxable expenditure to give this $5,000 to the mayoral candidate, but you did it anyway. If you have that situation, the foundation's going to get hit with an excise tax for taxable expenditures, but the foundation managers are also going to get hit with an excise tax. Typically, it's a percent of the overall taxable expenditure. For instance, oftentimes it's capped at a total of $20,000, and it's joint and several among all of the foundation managers. Let's move to advocacy and lobbying. Foundations can fund advocacy. I said you can't fund political campaign intervention, but you can fund advocacy. You can't earmark grants for lobbying. So I can't give a grant to an organization if I'm a private foundation and say, I want you to use this to go lobby these government officials to pass a law. Likewise, if an organization comes to me and says, we need money to go lobby government officials to pass a law, I can't give in response to that and say, great, here it is, and it's restricted for that purpose. However, if an organization comes to me and says, we've got this overall charitable program, a component of it is lobbying, but there are many other components that are not lobbying. I can give money to them and say, don't use my money for lobbying, and require that they show me that they're getting money from other sources that are unrestricted that allow for that lobbying expense. So you can't earmark for lobbying. You can't restrict for lobbying. You can't give to someone who says, I'm absolutely going to use this for lobbying. But you can fund organizations that do lobby through general support grants or through paying for the non-lobbying portions, and there are rules that apply to that. And so you see here a link to Alliance for Justice and to their Boulder Advocacy website. There is a document you can find there, Investing in Change, a funder's guide to supporting advocacy. Is great. And you can take a look at that. It's going to give you the rules, but don't think that you can never fund advocacy or lobbying. You just can't do it by earmarking or do it directly. You have to use general operating grants. And Exponent Philanthropy has samples on its website related to that as well. I see that there is a question, doesn't D&O insurance cover penalties? You need to check on your policy. It depends on, it really is going to depend on the policy. Some policies do, some policies don't. Making grants. Again, I've mentioned this briefly, but it's a good way to finish up here. Easy grants, 509A1 and A2 public charities. So these are going to be churches, schools, hospitals. By churches, I mean all sorts of churches, mosques, synagogues, etc. Schools and hospitals are always going to be included. And then other organizations that are primarily supported through donations or through revenue, like a ballet or something along those lines. You can also always make grants to government agencies. And you may think, why would I want to make a grant to the government? Well, it's not necessarily I'm going to write a check to the federal government. It's typically I'm going to make a grant to a library. I'm going to make a grant to my local independent school district. I'm going to make a grant to support my local firefighters. Instances such as that, the governmental entity is effectively treated as a 501c3 public charity. Grants with extra steps. We've mentioned these, but individuals for travel, study, or related purposes require pre-approval. Organizations that are not public charities, other private foundations, internationally based charities, all of those require expenditure, responsibility. Disaster relief for individuals, and you may say, I thought you said that didn't require extra steps. Well, the extra step that we're talking about here is that step of ensuring the person really does fit within the charitable class. Program-related investments, remember, substantial purpose is to accomplish a charitable purpose. No substantial purpose of making money and no purpose of lobbying. You're going to have a written PRI agreement, and often you're also going to have a written legal opinion. Certain types of advocacy funding, again, take a look at that Boulder Advocacy website, and then certain supporting organizations are also going to require a little bit more work. I would also say there's a grant with an extra step if you're making grants to controlled organizations, controlled public charities, for instance, where the foundation or its disqualified persons control the public charity. There are some extra steps that may apply in that situation as well. No extra steps for local school districts. If the local school district is an instrumentality of the state, then there is not an extra step. And you're making grant slides that suggest easy grants to 509A1 and A2. Our charter calls for grants specifically to 501c3. This is a good question. I wanted to explain the difference between 501c3 and 509A1 and A2, or between 501 and 509. So Section 501c3 describes an organization that is qualified. It gives you the organizational test that you're organized and operated exclusively for charitable purposes, and it gives you those charitable purposes like relief of the poor, education, or scientific purposes, etc., literary purposes. 509 is what distinguishes a private foundation, which is a 501c3 organization, from a public charity, which is also a 501c3 organization. So in the universe of 501c3 organizations, you have private foundations, you have public charities. That's your universe. Within public charities, within private foundations, you have private non-operating foundations, private operating foundations. And within the public charity universe, you have traditional public charities, or institutional public charities, they're called, churches, schools, hospitals. You have donative public charities, which are your 509A1 that are not traditional public charities, but are primarily supported through donations from the general public. And then you have 509A2 public charities, which are charitable organizations that are primarily, so they engage in charitable activities as set forth in 501c3, but they're primarily supported through revenue that they generate because people pay for their services or to get into their zoo, for instance. And then you have 509A3, which are public charities, but are a special type of public charity that is called a supporting organization. So private foundations and public charities are both 501c3 organizations. Does GuideStar differentiate to this degree? We count on GuideStar to confirm tax exempt status. GuideStar should provide you that differentiation, although I'm sure others will jump me if they don't. I can tell you that the 990 is going to show you what type of 509A entity it is, but you may have to ask on a 509A3 entity what type of 509A3 entity it is. Why? Because we want to make sure we're not making grants to non-functionally integrated type 3 509A3 entities. And that's a mouthful, but just suffice it to say, if you're giving to a supporting organization, then you need to ask some follow-up questions. Do I have suggestions for vetting the validity of a church since it's not required to file a 990? In Texas, churches to be exempt from sales tax have to file a little short application with the state. You might check that in your own state, but I'll tell you that short application is basically, are you really a church? Where do you meet? How often do you meet? How many families attend? Is there an order of worship? So, you're just making sure it is what it says it is, because you're going to have the burden if the IRS audits you on that issue. If they aren't in GuideStar, would we be correct in assuming they don't meet the appropriate tax exempt status? And the answer to that is not always, because churches, integrated auxiliaries of churches, and associations of churches are not required to file Form 990. So there is no Form 990. Governmental agencies are not required to file Form 990. So those types of organizations you're not going to find in GuideStar. Can we treat 509A1 and A2 the same way we treat 501c3? I'm going to say this again, and then I'm going to hand it back over to Althea to finish this up. 509A1 and A2 is a different issue than 501c3. Every single 509A1 and A2 organization is a 501c3 organization. So you can't simply say, we're going to give to any 501c3 organization, because a non-functionally integrated type 3 509A3 organization is a 501c3. The easy grants are to public charities that are either 509A1 or 509A2, but you can't simply say, can we give to all 501c3s? Because they're discussing different things. You want to make sure that you're giving to the type of charity that you intend to give to. And if I can help more offline, I am happy to do so. And with that, I'm handing it back over to Althea. Hopefully I've answered all the questions as we've gone along.
Thank you so much, Darren. And yes, I just have some final little housekeeping announcements. Right here, we have a list of some resources. I'll be sending them in my follow-up email, which you'll receive tomorrow. I also want to add that I'll be adding some of the additional resources that came up through the Q&A in the chat window. So if you didn't have a chance to click on all those or save them, no worries. I'll send them out after the webinar is over. And then I also want to mention to those of you who have a lot of specific questions about your situation, you may want to consider our Signature Plus membership. Because as important and as helpful as it is to educate yourself about the legal frameworks of charitable giving through our resources and programs like this seminar, sometimes you will find yourself in a situation when you're in need of personalized legal guidance. So that's where our Signature Plus membership level can be instrumental to you for your peace of mind. This offers all the benefits of Signature membership, plus guidance on legal matters that are relevant to operating a foundation and charitable giving. These are legal services staffed by lawyers who are experts in foundation and nonprofit law, and it assures that you're practicing your philanthropy legally and in full compliance with current regulations. I also just want to plug our social media. We're on Twitter, Facebook, and LinkedIn. And if we didn't get to your question today, you can email me. You can contact us through our Q&A service. I've also placed here Darren's contact information. Again, Darren, thank you so much for going through so many questions today and covering a wide swath of information for everyone in attendance.
Thanks, everyone.
All right, thank you. And that ends today. We'll see you on Monday for our next module at the same time. You'll receive a new link in your email to access that next module. Thank you.